Okay, well, we're going to move on to the next panel on which I belong, so I'll introduce myself, I guess. But Adam, if you'd join us up on stage, I believe you're on this panel, and Siobhan and Tom, and then Gary is going to moderate for us here.
Thank you. Now's a good time to escape, by the way. I know there are other panels going on. If you want to see different things, and that's more than fine. Oh, let's see if people lining up with their names here. No, Siobhan and Tom, but no, it's fine. We can. All right. Yeah, we're doing good now. All right. Well, this is actually, to me, one of the most exciting things that we get to cover because there's a frontier of new activity with merchant renewables, I'd say, following the footsteps of merchant thermal. And this is a kind of a game changer for the renewable field in that they've always worked on these long-term PPAs, and this has been the mechanism to support the financing of projects. Well, that's changing. We're seeing projects carry a significant amount of merchant risk. Ascend is going out and working with several entities right now on financing and getting, whether it's institutional equity or forms of debt, to support large merchant components of renewables and storage projects, mostly storage combined with renewables or storage alone. So what we want to cover is how do batteries as a physical hedge serve to support renewable projects and take advantage of over-the-counter hedge instruments and serve as a mechanism to have a relatively stable revenue stream with uncertainty in cash flow that are able to support debt or institutional equity. And so we have a few different perspectives here. From the buying side, we have Siobhan. You think after 100 times I'd get it. Siobhan Doherty is the director of power resource planning at PCE. So she's in the buy side. She works for CCA, just south of San Francisco in San Mateo County. Roughly peak load, just a bit below 1,000 megawatts, around 700. She holds an MBA from the Ross School of Business and an MS in Environmental Policy from University of Michigan, and she did her education out east at Smith. And I think it'll provide a really good perspective from the CCA side of you have risk that you're looking, the whole reason you enter into these contracts is to mitigate risk. And we saw that yesterday. I thought Monica Padilla did a great job of showing, hey, if you hedge just your net position exposure on a monthly basis, you're really still exposed. And it can be quite painful. Well, that's been the history of retail through time, is hedging a monthly average net position exposure and finding out, ooh, when the prices spike and load is high, you're short and painfully short. So this is your tough world and paradigm. And then to my immediate left is Tom Feiler, who happens to be the first person I met in Boulder about 23 years ago. So it's a great pleasure to have you next to me after all this time. And Tom is the director at Scout Clean Energy and has responsibilities around merger and acquisitions and new development activities in structuring. He's also definitely nationally recognized as an expert in energy policy and certainly is frequently asked to speak on these issues and has published extensively in the industry. He's really a thought leader. As well as being pretty renowned in the development space. Scott Wrigglesworth, I think we all know Scott by now. He's the director of analytics and strategy at Ascend and came off the trading floor maybe a a little over a year ago from AES, and he was happened to be using our software there for about a decade. So he knows hedging really well around physical assets and has done it for a living and in a risk-based framework with PowerSim. And Adam Hise, who I call Mr. Innovation. He's the principal and founder of EnBalance Storage, and I think he's going to pose some challenges to us just to wrap our minds around what he's trying to do with wind energy and storage and create kind of these synthetic products effectively using wind as using wind as an energy source, battery as a firming device, and looking at ways that wind projects can obtain higher rates of return through his company. And it's very interesting. So with this, I think we're going to take these perspectives in part of the right order. So Siobhan, I was thinking, since you're kind of the lead buyer, if you will, and have the biggest need, it'd be good for you to start. So Scott has a mic for you.
Okay. Do we have a clicker? Thank you. All right, thank you. Thank you for having me. So just going to start with a little bit of an overview of who Peninsula Clean Energy is. So as Gary mentioned, we are the CCA serving San Mateo County. For those folks that are not from San Francisco, I included a little map. We're just or not from the Bay Area. We're just south of San Francisco. CCAs are pretty new. We were the 5th CCA to form, and we were formed in 2016. So we're one of the older CCAs, but we're still only 3 years old. We started serving customers in October of 2016, and CCAs tend to roll out in tranches. So we finished rolling out to our customers as of May 2017. One of the things we look at is how many of our customers have chosen to go back to PG&E. So that's our opt-out rate. We've had a really flat, low opt-out rate of just 2.5% over the past 2.5 years. And one thing that we're really proud of is that we were the 2nd CCA to receive an investment-grade credit rating. We received that this past May. MCE, who was the first CCA to launch, they were the first one to receive their credit rating. And that makes us it's a lot easier to contract for long-term projects. Just an overview, I think most people know this, how CCAs work. We just cover the electricity generation part of customers' bills. PG&E, who is the IOU in our area, still responsible for transmission and delivery, and then our customers get that power. A little bit more about PCE. Our customers have 2 options for products. Our default product is 50% renewable. It's 90% greenhouse gas free, with that difference coming from large hydro. And that is priced at 5% below PG&E rates. And then our customers can also choose to opt up to a 100% renewable product. That one is certified by Green E. And that one is priced at 1 penny per kilowatt hour more than our default rate. A little bit about our customers. We've got just under 300,000 customers, about 2/3 residential, 1/3 commercial and industrial. And then our load is about 3,500 gigawatt hours, about 2/3 of that from commercial, 1/3 from residential. We have a lot of goals. The goals that are most relevant for my team, the Power Resources team, are these here. So that's to be 100% greenhouse gas free by 2021, and then to be 100% renewable by 2025, and to the extent possible, from an economic perspective, doing that on an hourly basis. So for every hour of load our customers are using electricity, trying to get an equal amount of renewables onto the system. And then the third one is 20 megawatts of new local power, so new projects in our territory by 2025. So as Monica mentioned yesterday, when CCAs form, we don't have portfolios. We don't have any dispatchable resources to manage any uncertainties around load or price spikes. Over the past couple of years, we've signed up a number of PPAs. Some of those are from existing projects. We've got 4 long-term PPAs with existing small hydro, about 12 megawatts. And then we've got 3 PPAs with existing wind. And those are shorter-term PPAs. That adds up to about almost 200 megawatts of wind. And then we've signed 2 PPAs for new long-term solar. One of those is under construction right now. It's 200 megawatts, and it'll start operating hopefully by the end of this year. And the other one will start construction this year and come online next year. So that'll be 300 megawatts of solar by the end of next year. Monica went over this really well yesterday, but just when CCAs buy energy for our customers, we buy it at the PG&E DLAP. We don't buy it at any particular nodes within that DLAP. And then when we have PPAs, we're receiving the revenues for those at whatever that P node is. So we're taking the basis risk between those two locations. So we've spent a lot of time looking at storage. There's three main areas where we look at value from storage. So one is time-shifting renewable production, so whether that's to take advantage of different prices within the market or whether that's to meet that 100% renewable load matching goal. Those are the two areas that we're looking at. Resource adequacy. We have requirements within California. I think everyone's familiar with those. Storage can play a big role, especially as we see more gas plants coming offline. And then finally, ancillary services. So this is one of the things that we look at, that we showed at our board. This is our expected load in 2025. That's that blue line across the top. Those orange lines are the generation from our solar projects. And then we tell them we want to fill in all that white space between the orange and blue with renewables in the next 5 years. So thinking through, solar, obviously the cheapest form right now, that's only going to get us so far. We're going to need a lot more. You might notice we have a lot more load in the winter than we do in the summer, and there's a lot less solar available in the winter than the summer. So thinking through what's the role of storage, what's the role of other types of resources within our portfolio. So some other ways we look at storage, so smoothing out solar generation. This is showing 10-second generation from a solar project in Arizona. When we look at solar, everybody knows this, it looks nice and smooth when you average it out, but we've got a lot of gaps in there as well. Also helping us to manage wind variability. This is from one wind project. Each of those colored lines represents a different day in the same month. And then that middle line is the average. So you can see a lot of variability between each day. And then also helping us to manage our load uncertainty. So each of these charts are showing June in a different year, 2019, 18, and 17. Each of the lines is a different day in June. And you can see our max, min, and averages are changing every day. From 2018 to 2019, there was a 100 megawatt difference in our peak load in June. So looking at storage to help us manage some of that variability in load as well. And then I think this was shown yesterday, California is looking at a gap in resources for meeting our capacity requirements and reliability requirements starting in 2022. So looking at what's the role for storage to play in helping us meet those requirements. And then about to the end, just a little plug, we are hiring. So if anybody is interested in helping us solve these problems, that's our website. And that's it, thank you. You next.
So anyway, I'm delighted to be here. Gary mentioned that we've known each other for 23 years. That's true. We've sort of become friends over 23 years. It's also worth noting that so I'm always very happy when we sort of have a chance to work together. But we live in the same neighborhood. Our kids grow up together, and our friends, our wives are in the same book group. So it's really fun when we actually get a chance to work together. And Gary, I just want to say we're really thankful for the work that Ascend has done for us in some very difficult analytics, helping us sort out a few things. Allison, Joan, and Scott are all outstanding, and we're really happy. What I wanted to talk about, what I sort of planned to talk about this morning, or this afternoon, what I'm actually going to talk about is a little different because yesterday morning, Allison sort of talked about the first half of what I was going to address, and now Scott and Adam are going to probably address the second half of what I was going to talk about. So rather than sort of plow the same ground twice, I thought I'd provide a little bit of background on sort of where we got to the set of problems that we're addressing today and the analytic work that Ascend is doing. If you look back at the beginning of the modern wind industry, which I would put in 2002, that was the year that GE bought Enron Wind. A year later, Vestas and NEG Micon merged. In 2004, Siemens bought Bonus. And sort of the manufacturing part of the industry was sort of up and going at that point. I came in as a developer in 2003, and we were anything but sort of up and going at that point. You know, the industry was characterized by a lot of small, very poorly capitalized companies, you know, and, you know, here we were in an incredibly capital-intensive industry with essentially no balance sheet, you know, trying to sell wind energy from wind turbines, which the financial community thought were, you know, too new, too risky, and too exotic. So the question is how are we able to finance these plants? And the answer was utility PPAs. And that's how we did it. We did it with utility PPAs. Utility PPAs basically gave us a guaranteed source of revenue from a creditworthy counterparty, and that was sort of what got the industry going. You know, if I were to ask a sort of a sophisticated group like this, you know, what would you think is the most important single thing that led to the growth of the rapid growth of the wind industry? I imagine a number of you would maybe answer that it was the PTC, which allowed us to sell energy at a cheaper price to our customers. You know, some of you may point to the early RPS legislation, which sort of created demand in a market in which there wasn't any at the time. My answer is the utility PPA. Essentially, we borrowed their credit as a way of being able to raise our offerings up to investment grade. This worked pretty well. You know, in sort of the first 10 years of the wind industry, I don't know how many projects were financed with PPAs, but I would guess the number is probably 100%. And if it's not 100%, it's a number pretty close to 100. Then the industry began to grow and mature. The utility PPA is still very important. It's still sort of the gold standard, but there's just sort of less of them than there used to be. You know, the utilities met their RPS standards. Many of them overcomplied. There weren't as many PPAs out there. Those that were out there were under sort of, there was intense competition for them. Margins got squeezed. Utilities started looking at wind as something they could own as opposed to simply contract for. And then the wholesale power markets began to evolve and to become much more sophisticated. And this sort of created what I might call sort of the second generation of wind projects where we started selling merchant into the market. And again, the question, how do you finance a merchant power plant? And the answer there was hedge instruments. So hedge is basically just a financial contract in which the owner agrees to sell a certain amount of energy during certain hours for a fixed revenue stream. They come in a couple different flavors. The amount of energy sold under those is usually the P99, so sometimes you hear these things talked about as P99 hedges or P99 swaps. Then they come in a couple different flavors, but basically what they did is the same thing that the PPA did, is they allowed us to finance using the credit of someone else as a counterparty. These P99 hedges, most of them have performed pretty well, but some of them are underperforming right now. And if you take a look at the projects which have these P99 hedges, if you look at those projects that are sort of underperforming their pro forma, they all have one thing in common, and that is they're all settling at a hub with high concentration of renewables. So the high concentration of renewables creates volatility. Volatility creates revenue erosion. And this is sort of, I don't know if you all remember yesterday morning when Ascend put up their heat maps with sort of the most volatile nodes. So think about that map. We have a wind project right in the center of sort of one of the biggest, reddest circles on that map. And that was sort of when we approached Ascend, because we needed two things. One is we needed to understand with more detail the nature of the dynamics, the nature of the volatility that we were facing. And the second thing is we wanted some help in thinking about how we could use batteries as a way to hedge some of that risk. So, you know, hedging has been around about 5 years maybe. You know, we did our first hedge deal in 2014. It's still got a lot of maturing that needs to happen. But in these very volatile nodes, it is difficult to see how that's going to happen with the instruments that we're currently using. And that's sort of the introduction of storage. So Ascend has helped us sort of analyze where we're going with that, and then helped us sort of understand in sort of, if we want to call it a third generation of projects, how that can help us, how introducing storage can help us finance the next generation. So what you're going to hear from Scott is to describe sort of the analysis that we've done, and then from Adam, we're going to hear about some of the new business models which are sort of emerging, in which we integrate storage with wind. So with that, let me turn it over to you, Scott.
Yes, thank you. Devin, can you cue me up just so I'm not jumping around too much? So it's been a pleasure. I've had opportunity to work with all three of these folks on stage here with me, and so it's been interesting to see Siobhan's perspective on how do we procure the clean energy, and Scout's perspective on how do we create it and make it sustainable from a financial perspective as a developer. And it's been really fun to work with both of their portfolios. Unfortunately, I can't recommend to Siobhan to buy Tom's energy, as it's got a too significant a basis risk given its states away. But nonetheless, it's fun to get to work with both of them. So this is just a framework for things that we do. So we pride ourselves in Ascend at producing meaningful uncertainty when we model. How do all of the factors in the energy life, if you will, tied together? How are they correlated and related, both on a forward basis, but more so even on the spot basis, the granular level. And so what things did we incorporate when we did the analysis for Scout? First, we made sure we had good market price uncertainty, current forward marks. We're not predicting the future of price. We're taking the market as the unbiased predictor, but we are determining what's the meaningful uncertainty around those prices. And then the spot price uncertainty, which I'll call shape, but different than the basis. So one of the dynamics that you're probably familiar with in highly concentrated areas of wind is that when the wind blows, the ISO says, we don't want your power as much, and they dial the price down. And if you take the megawatt hours, say on peak, off peak times the price on peak, off peak, you're going to be well overstating the revenues, because the fact that the basis is going to have produce a lower price when the wind is blowing. We also made sure that relationship was captured in the modeling. The wind renewable intermittency, so some of the stuff Siobhan showed as a risk that she bears when she buys a PPA from a wind resource, that's unit contingent, that range that she has to deal with, that's what we're modeling Ascend in a discrete way. We're making sure it's represented, not on a stress test, but actually modeling those patterns that we see. And then the assumptions around the battery were that they were it was fully able to participate in the market, so it wasn't exclusively needing to charge from the renewable resource. So it's the location being the same, but the ability to interact with the market was there to charge and discharge. And then we co-optimized the revenues between the energy and the ancillaries. So used PowerSim to make sure that we were capturing those relationships and chasing the best revenues. So what did we get? Well, this is two common portfolio management images that we like to work with and show. On the left is the distribution diagram, so probability distribution, and on the right is what we'll call a payoff diagram. Both are based on the same data, so I'll call out here that on the left chart, the margin, the gross margin, is on the x-axis, and then on the right chart, it's on the y-axis. And what we're showing on the left is just what's the certainty of the resource combination payoffs. And on the right, we're showing what's the sensitivity to market price. So relative to the hub at which a hedge would be agreed upon with the counterparty. So what you'll notice is that the renewable by itself is, it looks certain, right? Part of this is optical illusion, so I'll call that out. The chart is on an absolute basis, and so the lower margins, fewer opportunities for deviation from that lower margin. It looks more peaked, but it's a range relative to if I add a battery, which is the gold. So when we add the battery, you'll notice that the mean return, the mean margin on that goes way up, because it captures a lot more revenue opportunities, but it does have a significant range of uncertainty. And you can see that on the right in the payoff diagram. So you'll notice that at low prices, there's less dispersion, but if prices start to get higher, there's more dispersion uncertainty in the simulated outputs. So one way to think about risk on the right is if we use the x-axis, or the price at which we could hedge a forward contract, and this is we're just using a standard swap here, block power swap, monthly on and off peak. If we use that hedge of that market price, can we reduce the uncertainty in an optimal fashion? Now, if we had something that was had less dispersion, we could tighten up the green distribution on the left quite a bit more. We could make the trend line on the right in the green quite a bit flatter, but because of the dispersion, the optimal being what minimizes our gross margin at risk for this opportunity, what level is going to be the hedge amount that gets us to that flatter green line, albeit it's not completely flat or not completely indifferent to price. More importantly, from a developer perspective, is what does that do to my cash flow uncertainty? Now, in many cases, we might find that there are certain portfolios where we can take the blue line, which is the mean, and have the gold 5th and 95th around it, that uncertainty range, and tighten it up a lot to the blue. One of the things we discovered with this project is, we can maybe we can't tighten it up so much so that it looks like it's virtually certain. We can markedly improve it. So depending on how the cost and the financials play out, that hedge may allow a team like Scout to get more certainty around the performance and the investment decision. One of the things that we do too is turn this into a present value, because on a project basis, the distributions look similar here to what we showed, but the thing I'll call out here is the risk return score at the bottom, kind of like a Sharpe ratio. If I just have the wind resource, I get $3 of return for every dollar of risk. If I put a battery with that, I'm effectively creating, I'm oversimplifying here, but I'm creating a spot hedge. I'm, like Siobhan said, I'm smoothing out that volume and timing. That increases the score to 6. If I layer in the optimal level or the risk minimizing, gets me down from 94 million in present value at risk to 51 million in present value at risk, I can improve that score to an 11, so $11 of return per dollar of risk.
Before Adam, you go. So Scott, the idea is, if you go back just a slide, just to put this in context, you have a wind farm, or maybe in the back of the room.
I got it. We got it.
Oh, okay, great. If you're a wind farm, given its uncertainty, it's nearly impossible to go ahead and sell a monthly forward block for on and off peak, and certainly not a shape product. So
right.
PCE is looking to buy, and I can't meet their need for a shape requirement or a block. And the idea is, hey, we have a wind project, let's pair it up with a battery and see if we can't meet PCE's need for a shape product or a block. And this is saying, hey, using a monthly block, which is what you
right.
did, simple linear instrument, trade it all the time. We can go out 3 years, no problem, very liquid, and we can get a higher risk return than just hanging out in the merchant market.
Correct.
And if we look on a go-forward basis and we look at what we're seeing in the real-time price dynamics, and particularly the negative correlation between real-time prices and production, there's a compelling need to have that physical hedge. Not long duration, really, but enough to just firm the project so you can meet these commitments. And it's a matter of those real-time price spikes. They're very short-lived. Typically, the most they go for is 15 minutes, but they're very large in magnitude. And if your wind farm is negatively correlated with those, you have a problem because you want to meet production when the prices are highest, and you may or may not be there. Certainly, you don't have enough certain to be there unless you have the battery as a physical hedge. So short duration batteries versus the physical hedge, and it really brings down the risk to the point where if for a 3-year deal, you could certainly go to a bank and get a mini perm. And you could probably do some other more creative things beyond these hedges, and that's where Adam comes in.
Yep. And one thing I will add that I didn't mention is that hedge level, it's not uniform. So we did find that some months we didn't need to put a hedge on because it didn't do anything for that risky month, but other months made a big difference.
Great. Well, thank you, Tom and Scott, for teeing this up so nicely for me. And Gary, you pretty well summarized everything I was going to say, so I'm not sure that there's much left for me. But I appreciate the chance to be up here with this esteemed panel. I've also had the chance to work with everyone up here. And Gary, thank you for putting on this excellent event. It's been really fun so far. So what I'm going to talk about is creating a more financeable storage product in evolving energy markets. And really what I'm looking to solve with this solution are two problems that we've covered to some degree already pretty well. The first is one that Scott really just touched on, which is the way in which renewables are destabilizing power markets. And as we talked about as well earlier this morning, how that destabilization is actually eroding returns for renewables in these heavily penetrated markets. The second is a related issue, really. It's that these markets are really creating an opportunity for battery storage, but that investment in those storage systems has been limited by the merchant nature of the returns that batteries are forecast to achieve. So EnBalance is looking to solve both these problems, and in doing so, we're looking to create a better risk management tool for renewable generators and bring the value of storage to folks who really don't have the ability or willingness to invest in storage themselves, ultimately to accelerate the deployment of storage across the entire grid in a way that supports the carbon-free grid that we're all hoping to be a part of achieving. So this is a really conceptual overview of kind of the return on invested capital that's required as a function of the risk of project returns. And I'm not really going to spend any time thinking about the technology or operational risks associated with different technologies, but what I'd like to talk about today are the offtake structures that have been put in place to de-risk these projects. And Tom did a great job of setting up this topic. My only really point to add is that pools of capital are somewhat discontinuous with respect to risk. So when we're in this high risk kind of region of this diagram, that's a high return on capital that's required for capital to get invested. And that tends to be a dedicated group of people willing to put their capital at that level of risk. As we de-risk projects with PPAs and hedges, that opens up the investment landscape to a much broader pool of capital of debt and public equity, as well as kind of lower risk infrastructure investors. And I would argue, as Tom did, that the evolution of these structures has really accelerated the growth of these markets. So just a quick kind of illustration of that, I'm really going to focus today on opportunities in SPP and ERCOT, where the financial hedging structures that Tom discussed have really propelled the growth of renewables in these markets. And that's largely due to the liquidity of trading hubs in these markets. So Tom mentioned that these financial risk management structures come in a variety of forms, whether they be the fixed volume swaps that Tom mentioned, proxy generation, proxy revenue swaps, even the virtual power purchase agreements that have been a fantastic tool for accelerating deployment of renewables in the last 3, 4, 5 years. Those are all really dependent on liquid trading hubs that allow off-takers to offload their price risk that they enter when entering into these contracts. So all of this penetration has triggered some macro grid responses that we've touched on pretty well. This is just illustrating penetration and power prices across a number of different markets. This is that negative correlation between generation and power prices that we've touched on several times. What I think is more important to consider is kind of the micro effects that the generators see in this dynamic. And so this is generation versus pricing for a project that is serving as kind of the pilot for this EnBalance solution. You can see that when the generation at this facility is between zero, roughly nothing for the facility, power prices are high, both at the project node and in the day-ahead market at the hub. As generation increases all the way up to nameplate, we see this broad separation between the day-ahead power prices, which remain fairly strong, and the nodal real-time prices, which in many hours are well below zero, but average right about zero. So the only point that I want to make here is going back to this risk and return diagram. The evolution of these markets in response to significant levels of renewable penetration is changing the risk profile and actually changing really the availability of capital that will support projects under various offtake structures. So what EnBalance is looking to do is kind of provide a new solution that both, as I mentioned earlier, provides a new sort of risk mitigation tool for wind and solar, really, but the wind variability provides a really unique opportunity, we think. That also facilitates the financing of battery storage projects. And so this is all kind of around the thesis of a parallel sort of evolution. So technological evolutions in wind and solar have made those resources cost competitive, the most cost competitive generation sources on the grid in many places. That's allowed these financial structures to emerge to support significant deployment of those renewables across power markets. That significant deployment has led to widespread depression of prices and localized congestion leading to significant basis. That's all kind of contributing to erode the value of the risk mitigation structures that were put in place to support the investment in these projects in the first place. So the EnBalance solution is really the idea being to both evolve, have a co-evolution, if you will, of the business models and risk management structures alongside the evolution in technology and markets. So I just wanted to kind of use this as an example. Tom teed this up great. I don't really even need to walk through this, but the fixed volume swap has supported a lot of wind development across ERCOT, SPP, PJM, CAISO less so, but the projects have been developed on the idea that they are less risky because they have these risk management structures in place. And what this structure does predominantly, what it's intended to do at least, is pass off the downside price risk that the project sees to a swap seller. What it actually does is pass off the downside price risk at the liquidly traded hub, which works well until that hub no longer serves as a good proxy for downside price risk at the node. What it also does is pass off the upside price potential. Because this is a swap, the wind generator passes off the downside risk in exchange for giving up the upside price potential. And as these hubs become more volatile, that ends up being pretty costly, actually. In exchange for passing off the downside risk and giving away the upside price potential, the wind generator takes on shape risk. And so this is just the mismatch between the fixed volume and the value of that fixed volume at the hub and the actual generation and the value of that actual generation at the project node.
And the fixed volumes are monthly?
Monthly on and off peak, usually set to P99 values. So expected generation will exceed those volumes 99% of the time, which doesn't ultimately turn out to be that true. But the final risk that is important for us to consider here that the swap buyer, the wind generator, takes on is basis risk, and that's just the spread between the nodal price and the hub price that the wind generator settles on. So as the market's evolving, these risks are evolving with it. As I mentioned, the volatility at the hub is changing the dynamic between downside price protection and the I guess, giving up of upside price potential. The shape risk is worsening as the negative correlation between generation and prices reduces the value of the energy that we actually generate and potentially increases the value of energy in hours where the grid is short wind energy. And basis risk, as I showed, that one project is kind of emblematic of this. Heavy concentrations of contemporaneously generating renewables in various parts of the grid is leading to this localized congestion that creates a really challenging basis risk problem. So all that leads to the solution, which I won't have the opportunity to get into too much detail on the stage, but happy to talk in private more about how this is coming together. What we are proposing with this EnBalance storage solution is finding a way to only pass off the downside price risk at the node from the wind generator to EnBalance. This is really, Tom called it the third evolution of, the third stage in the evolution of risk management. We are looking to create a risk management tool that is better suited for the market that we find ourselves operating in today. It's a tool that provides better downside protection with less cost to wind generators and ultimately is facilitating as well the deployment of more storage resources that will be required to sustain reliably the grid that we're all trying to help create. And I believe that's all I have.
All right, Adam, I'm going to make you bring that last slide up again, if you
Okay.
can. Yeah, exactly. So from a commercial perspective, we're looking at a wind farm. All right, it produces, and unfortunately it produces, and the real-time prices go lower. In the end, everything settles to real-time price. So while the day-ahead price might be pretty good on average, there's a drop, maybe 10, 15% to the real-time just because of that negative correlation. Could be worse, could be 20. Storage steps in, and that's just with production alone on the hourly basis. It's with volatility, we see this increasing and these differences mattering more. They go out for traditional, you go back one more slide. Swap with a fixed volume swap with some insurance company, something like that. And they're assuming some basis risk, a little bit of shape risk, but they're getting a deal done. What's the problem with these deals?
It's really the increase in some of these risks. So while these swaps did provide good protection for projects, that don't face worsening basis and shape risk, that's a pretty small subset of projects these days.
Okay, so how do the returns look from an equity side? If I sign up for a deal with a bank or something on a fixed for floating swap or fixed volume swap, I should say.
Yeah, better than merchant, but worse than a utility PPA.
Well, better than merchant means you're not going anywhere, so that's not
Right,
good.
Exactly. Yeah, I mean, this structure has supported successfully the development of many, many projects. There's been some evolutions in this recently. I think the proxy generation, proxy revenue products are a good way of mitigating a lot of the shape risk that projects are facing, because that moves from this fixed volume construct to a as generated volume, but you still face basis risk. And I think that is going to end up being the killer of many projects that are being developed today and next year as developers race to get everything in the ground that they can. There's going to be a lot of projects in the early 2020s that are suffering under the offtake structures that were intended to provide revenue certainty for them.
All right, if you go to the next slide. It's just one, yeah. So your solution is, hey, look, I can step in and, the word on the street is if you take a deal as a wind developer with a bank, you're basically not going to get any return on equity for the first 10 years. And so why bother? And I think that's the way a lot of folks feel. It's just why bother? This is just not sufficient. We're not going forward with it. you're going to step in and say, look, we see the price in, let's say, ERCOT for the Fords, and these are pretty attractive. How can we use this EnBalance solution? And at a high level, what are my returns going to be? And how would this be a game changer for me?
Yeah, I mean, there's a few things to unpack there, but ultimately it's just the idea of passing off risks to the groups that are best suited to wear them, right? And this basis risk continuing to be held by the wind generators is not a good solution. You've had the reinsurers step in to take some of that shape risk. I'm proposing that storage resources specifically backed by me and this company, serve as a great way to offset nodal price risk for generators that provides the downside protection that they need without them being exposed to these new risks that they aren't prepared to manage well.
And so when we look at merchant storage alone, we see returns at sweet nodes, sometimes paybacks within a couple of years for really good nodes. And that's just on an energy basis, excluding RA. So, you can have projects that are well under 2 years in California. In your markets, let's say there might be some capacity component, which may or may not be relevant, but on the energy side, if we're just looking at taking wind production and firming it, how do the returns differ? So we're looking at basically paltry returns on equity to the point where people aren't doing deals. You step in with an EnBalance, and how's this going to help me as a developer in terms of returns? What should be my expectations in a range?
So, like I mentioned, we're kind of in the pilot phase of implementation for this. So I can't tell you how a new project actually looks, but our anticipation is that this is a solution that's going to work to step in and kind of push aside some of these existing risk management solutions for projects that have already been financed and developed and constructed, and finding their risks to be less palatable than they intended them to be, and also support new projects. So we're working with a solution provider to wear the long-term risk that will allow us to provide 10-plus year products in which the wind generator passes off downside nodal price risk, and they receive that by way of EnBalance working with its partners to wear that long-term nodal risk.
So the cash in the table is simple. You're looking at roughly a $15 megawatt hour deal with a bank, and you look at the market, and they're, let's say, 30 plus per megawatt hour. So there's at least $15 a megawatt hour cash on the table, and that's how you're increasing the returns effectively. You're going after some of that by firming this with storage.
That's right. And these swaps, effectively provide 24 hours of downside price protection that wind generators don't really need. They need protection against the worst couple of hours where a lot of your generation shows up and the nodal price is negative $25. They don't need that for 24 hours a day. And these batteries are going to be operating in regions of the grid that benefit from the same dynamics that are hurting wind generators.
So to drive this home, if we looked at ERCOT, is Michael Anger here? Oh, okay. Correct me if I'm wrong here. This past summer, we've seen prices in the day-ahead market, $5,000 a megawatt hour plus, for multiple on-peak hours, a large, basically a large portion of the on-peak block, kind of from, let's say, 3rd of August through mid-September. Quite a few days of this. But the real-time prices we saw, I think the max we saw was just a handful of intervals at about 15 minutes at about 3,000. Did I get that?
We did hit $9,000.
Oh, you hit it 9,000.
We stayed up there for over an hour on 2 different days. There were a couple of days that they had to call the emergency response services and issue EAs.
All right. So if everybody didn't hear that, there were just a couple hours of $9,000, a handful of 15-minute, in the 3,000 plus range, but that's it. And we look at short duration storage as typically kind of an hour and 20-minute battery. I'd say an hour battery, something that can firm. That's all you needed to capture large risk premiums. So day in, day out, you could bid in the day ahead market without losing sleep with a renewable resource. Maybe you'd have a 2-hour battery in this case, but you'd be able to firm and provide financially and meet kind of the real-time price dynamics with storage combined with renewables and take advantage of extreme premiums of the day ahead over the real time. After those first kind of days where the real time blew out the day ahead, it didn't happen ever again. The day ahead was far greater than the real time. And that's what our predictive analytics that Allison went over was showing is, there's a pattern. Day ahead blows out, real time blows out day ahead, and then from there in, there's so much anxiety that the day ahead is constantly greater than the real time just because of the fear factor. And there are days, 5,000 was the day ahead, it settled at around 50 in the real time, again and again. Well, nobody wants to get $50 when you get 5,000. The only way you're getting 5,000, and that's the cash on the table that you're trying to effectively garnish, is with the imbalanced solution.
Yeah, I think, your team, Allison and Scott, have done a great job of convincing me, at least, probably convincing most people here, that there's a lot of ways that that you can benefit personally as a owner of storage, but also as a renewable generator, having the value that storage can create for you. My argument is that most people in the industry are not willing to take the merchant exposure that's required to truly benefit from a battery in a market like ERCOT or SPP. And this is a way that renewable generators can benefit from that value without having to take on those risks themselves. Again, a risk I don't believe they're well situated to manage.
That's great. And I understand it's project by project. Somebody comes to you with a project, you'll tell them what you'll be able to do for them. Is that right?
That's right.
Okay. All right. I think we're getting close on time here. But I want to thank before I thank the panelists, hold on. I have to open up the room for questions. I forgot. So we have time for questions. Go ahead.
So solar is definitely newer to the game here in terms of signing up some hedge contracts. So I guess my question is more for Tom, but really open it up to the whole panel. From a volumetric risk perspective, something I'm often told is why not just use weather derivatives rather than storage? So curious to hear your take on that. And then with regard to basis risk, something I don't hear a lot of people talk about is what role do FTRs or CRRs play in managing basis risk?
Yes, that's sort of a lot of questions. Our ability to predict wind is much better than it was a few years ago. So we're doing everything we can, sort of with the most modern technologies. One of our guys, I don't know if Augie's here in the room, he could tell you exactly, the detail with which we manage that, but it's not enough. It's not enough. So the basis risk is part of the issue. The other part is sort of as Adam was talking about, which is just sort of the correlation between prices. And as long as that correlation between prices continues to grow, you're going to need some way to physically hedge it. Because these nodes are not, the hubs at which these things are settling are not getting any better, right? The more and more wind that we drop into these already wind-rich areas is making this dynamic worse, not making the dynamic any better. So we've got to have some way to be able to manage that, and physical storage is a way that looks really, from a financial point of view, physical storage is something that looks really attractive. Scott, do you want to answer?
Huh?
Yeah. Oh, go ahead. Well, I guess my only point on FTRs, from my fairly limited knowledge of them, is that they are useful, but an imperfect tool for managing basis. Useful as long as you are stuck under a hedge arrangement that has you settling at a hub, and I'm proposing that we do away with that construct over time. So keep on doing the FTRs while you have to, but this could be better.
Yeah, I was just going to add, FTRs or CRRs, they can be useful. some paths are much more reliable or predictable in terms of the payoff. And in a lot of cases, history isn't a good indicator of what to expect in the future with them. So you just have to be careful. Weather derivatives, I've been in many conversations where the proposal was, well, this is, a weather derivative solves this, and probably maybe does, but the premiums might just be a bit more than you'd want to take on to get that protection, right?
Yeah, I would just add two things to this. FTRs are going to pay for. So the question is it worth it? It's just to mitigate risk. It doesn't address the issue that you have a node that has negative basis relative to the hub. And that can't be solved with an FTR, period. And the other is, I think the source of the risk is a little bit different for what a weather derivative would accomplish versus a storage asset. So a weather derivative is going to attack volumetric risk on a seasonal basis because they're monthly heating, cooling degree days based. So there might be kind of a big monthly block, whereas storage is getting at the high frequency, high volatility events, so these price spikes. And it's a physical hedge specifically designed to capture a new phenomenon. I mean, look, this 5-minute market stuff is new. These spikes are even newer, and where they're going is even newer. And this creates new opportunities. And so how can we pair up something that's inherently an energy machine, like wind, with something that's really good at squashing volatility, like storage, and make a shape product that makes PCE happy that they can get clean energy to serve their customers, some of which, in your case, are looking at around the clock, hour by hour, can we track our RECs, right? And actually, I do have a question for you on that. So there's the mic coming your way. This is an important kind of transformation, I think. Google started it, and it's catching on, I know, in your world and in your customers. I want to see something more than RECs, let's say, by the year or by the month, and starting to look at hourly. How is that impacting what you're looking for in terms of energy purchases?
Yeah, so today we're just doing our accounting on an annual period. We say our customers use 3,500 gigawatt hours. We want to be 50% renewable, 50% times 3,500. We need to buy that many renewables. We don't buy any what's called PCC3 in California or unbundled RECs. We only do the bucket 1 and bucket 2, so generation inside California or the firmed and shaped to California right now. But looking towards the future and trying to get to this goal in 2025 of matching our renewable generation with our load on an hourly basis definitely changes how we look at resources and how we value them. So we just look at PPA prices, solar plus storage or solar alone would get us to that renewable number by itself. But trying to get into, it's not going to get us there on an hourly basis. We're not going to have enough generation in the wintertime unless we way overbuild, and we're not going to have generation for meeting our peak or our overnight electricity usage. So when we think about our portfolio, we're thinking about it from a much more diverse perspective. And I think solar and storage and wind will all be big parts of it, but also looking, and similar to what Monica said earlier, looking at geothermal and other resources that could provide some of that base load that look more expensive on just $1 per megawatt hour PPA basis, but are going to provide different sources of value for us beyond just what solar would provide on its own.
That's great, thanks. I mean, that's a big change from monthly to down hourly. And, you know, makes storage come into the fold a little more. Different forms of storage, too. I mean, we're talking 24/7. And, you know, Facebook or Google running big data centers are looking for 24/7 clean. And so it's the portfolio as well, and this is a new challenge, and it's something that we'll be all tackling and trying to meet in the coming years, I'm sure. So are there any other questions? You get a mic?
I do not, but I can yell.
That's all right, great.
Go for it. So for the structure that we're envisioning for physically backed hedges, is that doing away with the fixed volumes and going more towards like an as-generated model, or is that still maintaining the fixed volume aspect of it?
Okay. Adam?
I think so. It's being structured currently as generated at the node. You know, it could be structured in a number of different ways, and the pricing of the structure would vary with the sort of risks that the option seller, me, takes on. But I think the value of this is that you are able to move away because of the unique characteristics, the unique relationship between storage and pricing and wind generators and pricing. You're able to move away from those sort of obligations, whether they be hub settlement or fixed volumes that impose additional risk on the generator.
I actually also have one more question, just on actually the previous slide deck for the chart with the GMAR. Just wondering what the size of the battery was relative to the wind farm in terms of power and duration to get that sort of improvement in margins.
Yeah, it was about 75%. It's a 2-hour battery.
All right, are there any others? Or, all right, well, let's have a round of applause for the panel, please.